Hello investors and finance learners. We are Harium Capital and come up with a new learning video titled Decoding Debt, Is Debt-Free the Way to Go for Stock Investors? Through this video, you will get a good overview of debt and stocks. So watch the video till the end and don't forget to like, share, and subscribe to our channel and video. We are talking in this video about these points. What is debt? The power of debt-free stocks. Analyzing debt in the stock market. To invest or not to invest. Knowledge is power. Caution related to investing and finance.
So the very first question that comes into everyone's mind is what actual debt is. Refers to the borrowing of funds by individuals or companies to finance various activities. It is a common financial tool used to raise capital for business expansion, investment projects, or to meet financial obligations. Debt has many types. Debt's type. Debt can come in various forms, including bank loans, corporate bonds, government bonds, and credit card debt. Each type of debt has its own terms and conditions, interest rates, and repayment schedules. Liabilities. In accounting, debt is recorded as liabilities on a company's balance sheet. It represents the money owed to creditors or lenders and reflects the company's financial obligations. Leverage. Debt can be used to leverage an investment, amplifying potential returns. However, higher leverage also increases the risk, as it magnifies losses in case of adverse market conditions. Debt-to-equity ratio. This ratio measures a company's financial leverage by comparing its total debt to its shareholders' equity. A high debt-to-equity ratio indicates that the company relies heavily on debt financing, which may signal higher financial risk. Interest payments. Borrowers are required to pay interest on the borrowed funds, which represents the cost of using debt. Interest payments can significantly impact a company's profitability and cash flow. Debt repayment. Borrowers are obligated to repay the principal amount along with interest over a specified period. The repayment terms and schedule depend on the terms of the debt agreement. Debt-free companies. Some companies manage their finances prudently and operate with little or no debt. These debt-free companies often have more financial stability and are less vulnerable to economic downturns. Debt and stock prices. The level of debt a company carries can influence its stock price and investor perception. Excessive debt may lead to a lower credit rating and reduced investor confidence. I hope now you understand about debt and we will go for new point debt-free stocks. So are you interested to know which stock will give you the freedom to invest your money? Then watch the video till the end. If you still have not clicked on the subscribe button, then subscribe to it.
Investing in debt-free stocks can be a game changer for savvy investors seeking stability and long-term growth in the stock market. These companies have a unique value that sets them apart from their debt-laden counterparts. Some characteristics of a debt-free stock. Financial stability. Debt-free companies are inherently more financially stable. Since they have little or no debt obligations, they are less vulnerable to economic downturns and financial crises. This stability provides investors with peace of mind and confidence in the company's ability to weather challenging market conditions. Strong cash flow. Without the burden of interest payments and debt repayments, debt-free companies enjoy higher cash flow. This surplus cash can be reinvested in the business, used for expansion, or distributed to shareholders as dividends. Strong cash flow is a key indicator of a company's healthy financial position. Reduced risk. Companies with little or no debt carry lower financial risk. They are less susceptible to defaulting on their debt obligations, which can lead to credit rating downgrades and loss of investor confidence. Reduced risk translates to a safer investment choice for shareholders. Focus on growth. Debt-free companies can focus on strategic growth initiatives instead of diverting resources to debt management. They have the flexibility to invest in research and development, acquire competitors, and expand their market presence. This focus on growth can lead to higher returns for investors. Increased profitability. Debt-free companies often have higher profitability due to lower interest expenses, with more profits available for reinvestment or distribution. Shareholders can benefit from increased returns on their investment. Attractive investment opportunities. Debt-free stocks can be hidden gems in the stock market. Investors who recognize the value of financial stability and growth potential are drawn to these companies, leading to potential appreciation in stock prices over time. Sustainable dividends. Companies with little or no debt are more likely to pay consistent dividends to their shareholders. Dividends provide a steady stream of income for investors, making debt-free stocks an appealing choice for income-focused portfolios. In the next slide, you will see some debt-free stock in the market, and we also provide a source link in the description so you can check it all. Debt-free stock. As we said in our reel on Instagram about top debt-free stocks from different sector, and here this stock is Tata Consultancy Services. Tata Consultancy Services is an Indian multinational IT outsourcing company and subsidiary of Tata Group, with more than 600,000 employees across 150 locations in 46 countries. TCS is the second largest company in India by market capitalization and 8th by revenue. Divi's Laboratories Limited. Divi's Laboratories Limited is an Indian multinational pharmaceutical company and producer of active pharmaceutical ingredients and intermediates. Headquartered in Hyderabad, the company manufactures and custom synthesizes generic APIs intermediates. Hindustan Unilever Limited. Hindustan Unilever Limited is a British-owned Indian consumer goods company headquartered in Mumbai. It is a subsidiary of the British company Unilever. Its products include foods, beverages, cleaning agents, personal care products, water purifiers and other fast-moving consumer goods. Bharat Electronics Limited. Bharat Electronics Limited is an Indian government-owned aerospace and defense electronics company. It primarily manufactures advanced electronic products for ground and aerospace applications. BEL is one of 9 PSUs under the Ministry of Defence of India. SBI Life. SBI Life is an Indian life insurance company which was started as a joint venture between State Bank of India and French financial institution BNP Paribas Cardiff. SBI has a 55.50% stake in the company and BNP Paribas Cardiff owns a 0.22% stake. So, if you watch video till now, then you will get a good knowledge of debt and debt-free stocks. So now, we will see is investment in debt stock is good choice or not.
Now we have 5 stocks and we know how much they stable. These tables marked point show how much these stocks are good for your investment in share market. There are some points also that we'll keep in mind if you are going to invest in the stock market. These points are: limited leverage. Companies without debt may have limited access to leverage for strategic expansion, potentially impacting their growth prospects compared to leveraged firms. Slower expansion. Debt-free companies might grow at a slower pace compared to those using debt to finance aggressive expansion plans. Industry variation. The suitability of debt-free stocks depends on the industry and its capital requirements. Some industries may benefit from using debt prudently. Opportunity cost. Focusing solely on debt-free stocks may lead to missing out on potential opportunities in well-managed companies with prudent debt utilization. Now we can go for data analytics of a share. Understanding how debt can influence stock prices and overall financial performance empowers investors to make informed decisions.
Debt-to-equity ratio, DE ratio, a company's total debt to its shareholders' equity. A low DE ratio indicates that the company relies more on equity and is less leveraged, which is generally considered favorable for investors. Interest coverage ratio. It is calculated by dividing the company's earnings before interest and taxes, EBIT, by its interest expenses. A higher interest coverage ratio signifies that the company generates sufficient earnings to cover its interest obligations, indicating a healthy debt management position. Current ratio. The current ratio compares a company's current assets to its current liabilities. It assesses the company's short-term liquidity and ability to meet its current debt obligations. A current ratio above 1 indicates that the company has enough current assets to cover its current liabilities, providing confidence in debt repayment capabilities. Debt-to-asset ratio. The debt-to-asset ratio compares a company's total debt to its total assets. It shows the percentage of a company's assets that are financed by debt. A lower debt-to-asset ratio indicates a lower financial risk and better debt management. Debt service coverage ratio, DSCR. The DSCR evaluates a company's ability to service its long-term debt. It is calculated by dividing the company's operating income by its total debt service, principal and interest payments. A DSCR above 1 indicates that the company generates enough cash flow to meet its debt obligations. Credit rating. A company's credit rating reflects its creditworthiness and ability to repay debt. A higher credit rating suggests lower credit risk and vice versa. Investors can assess a company's credit rating to gauge its debt repayment capacity.
Every sector wants some skills and knowledge. And if you watch our complete video, then you gain some knowledge of debt and can be selector stocks. On basis of some analytics, we believe that knowledge is the key to financial success. Join us on this exciting journey as we break down complex financial concepts into digestible pieces of wisdom. Before embarking on any investment journey, it's crucial to remember that all investments carry inherent risks. At Hariom Capital, we are committed to offering reliable and professional financial advice to assist you in achieving your investment objectives. However, it's essential to recognize that investing involves risks, and the decision to invest ultimately lies with you. We encourage you to carefully assess your risk tolerance, financial goals, and investment horizon before making any decisions. Keep support and don't forget to like and subscribe our channel.